Okay, yeah, good evening. Sorry for the earlier mix-up. Please confirm that you can hear me and that you can see the screen that I'm sharing. I'm trying to share a slide, tokenomics. Just confirm that you can hear me and you can see my slide, please. Please just put the comments in the chat so that I will know that you can hear me and you can see my slide. Okay, so I'll just continue. So in our earlier classes, we had spoken about how to, earn above $10,000 interest on your coin, on your token. We specifically looked at staking time on the Wonderland protocol. And in the second class, we looked at earning a passive income from stable coins. Stable coin because it's not volatile and you beat the bank and any fixed deposit rates by just investing your stable coin on the protocol that we discussed about, and I showed you other places where you can farm for better rates. Now today, what we'll be looking at is the tokenomics. So this is, before you invest your money in any token or any project, you need to know some numbers. You need to do some due diligence. And this is where the tokenomics of a token comes in. By knowing the tokenomics, you can then make a decision. You can make a decision that is based on data for you to either invest or not invest in a particular coin. So what is tokenomics? So question, what is tokenomics? Yeah. One moment, please. So question, what is tokenomics? Now, tokenomics is a combination of two words, token and economics. So it's the study of economics of a crypto token. So we are looking at studying the qualities, the distribution, the production, and some other things of a token. And it's one of the major checklists that you have to take care of. It has to check out when you are doing your due diligence on whether you should participate in a project or you should invest in a crypto token. Now these are I need to give you these definitions, this terminology, so that you understand what we are discussing. So what are crypto tokens, you will ask? And I need to mention this: crypto tokens should not be confused. You need to know the difference between tokens and cryptocurrency. They are similar in the sense that they have a value, and they can be exchanged, and you can hold it. It can store value for you, but they are completely different digital assets and class. So crypto tokens are units of values that blockchain-based projects build on an existing blockchain. So take Ethereum, for example. Ethereum is a blockchain, is a network, and then when you then build a unit of a project on the Ethereum blockchain, that project could be called a token. And tokens are not cryptocurrency can also be a token, and a token can also be some denomination of some cryptocurrencies. So for example, you can build a protocol or a project that allows you to, let's say, access Netflix if you hold 10 units of Terra Luna, just as an example. So those units of value, those denominations are what you call the tokens. Now we have to classify tokens into separate classifications. So one first classification that you can use to classify tokens are layer 1 tokens and layer 2 tokens. So what are layer 1 tokens? Layer 1 tokens represent a specific blockchain and are used for other services like investment, storage, purchase. Then they settle every transaction on their network. Example, Ethereum. In this course of this class, you will hear me talk about Ethereum a lot. And that's because of the unique proposition that Ethereum has, So Ethereum is a layer 1 token, like I've said here. So because Ethereum is used to settle all transactions on the Ethereum network, you can use AVAX, which is also another layer 1 token, to settle all transactions on Avalanche network. You can use what's that again? You can use, let's say, Binance Smart Chain (BSC) to settle, BNB to settle all transactions on the Binance Smart Chain network. So those are examples of layer 1 tokens. Then go down to layer 2 tokens. They are basically designed to help scale a dApp in a network. So meaning that they are built to solve a problem. An example is Matic on the Polygon network. So they are built to solve a problem, and this is where you have to start thinking about use case whenever you are evaluating a project. So looking at, okay, what is the problem that this token is solving, and those are one of the things that you need to consider, and that's why some layer 2 tokens are really important, looking at the problems that they are solving. And like I said, an example is Matic. Another way you can classify tokens, whether they are fungible or non-fungible. So fungible tokens are, or let's define fungibility. So fungibility is the property of assets to be interchangeable for another of the same kind. So fungible tokens are the ones that have the same values and can be replaced with each other. Take Ethereum, for example, or take Bitcoin, take Solana. One Solana is equal to one Solana. They have the same value. One Solana in US is the same Solana in Afghanistan. One Bitcoin in Nigeria is the same Bitcoin in Ghana. Okay, that's on the virtual side. Now, even let's look at, apart from digital currency or digital asset, look at normal assets. Take gold, for example. One ounce of gold in South Africa is, probably has the same value as 1 ounce of gold in Australia. So these are interchangeable and they are fungible. Now, the other classification is non-fungible tokens. So, NFTs, you've been hearing of NFTs, a lot of people don't understand it, but, or a lot of people know what it means, but, they've been struggling with how they can make money from it. And I will advise you, if you don't know what you are doing, you should not just jump into NFT. You need knowledge, you need to have an understanding of what is going on in that space. So, NFTs are unique, they don't have the same value. And I know I mentioned in my first class about using DeFi to tokenize assets. Take furniture, take artwork, take real estate, and tokenize them, convert them into digital assets. So basically, NFTs are physical items that have been tokenized, so they are being held digitally. So digital ownership has made NFT popular in recent years, and a lot of some NFTs are auctioning for millions of dollars, $69 million, those kind of crazy figures. And now, what are examples of NFT? Like I said, digital artworks and digital real estate. They can only be one type. And take, for example, there is crypto punks. Yeah, those are collections of NFT. You could have something that looks similar, but they do not have the same value, because no non-fungible token can have non-fungible token can have the same value, because that is what they are. They are non-fungible. And okay, let's step outside the digital world now. Take a movie ticket, for example. A movie ticket or a ticket to watch a football match is assigned to a particular seat. You cannot divide that ticket into two. and you share the seat. So that ticket at that point is not fungible. It's for a particular match on a particular seat. So it has its own unique value. Yeah. So in subsequent classes, I mean, I would really try to break down maybe NFTs in one of our upcoming classes. I'll put it on my calendar, so I'll let you guys know. Then another way you can classify tokens are security tokens and utility tokens. So for security tokens, I'm sure you guys have heard about XRP, Ripple versus SEC, that's Security Exchange Commissions of the United States. So why is there that battle between XRP and SEC? It's simply because of the way XRP launched their token. According to the SEC, to them it feels like the token was launched as a security. So, and I mean, according to the US laws, the SEC is the body that is responsible for governing all security exchanges and all that. So the way a token is launched matters a lot. Then we have utility tokens, which are tokens usually issued through initial coin offering. So you have pre-sale, you have investors coming in to buy the token, to increase the capitalization of the assets. So that's another way through which you can classify tokens either as security or utility token. Now let's start going deep now into the indices, the things that you need to, the checklist that you need to have when you are talking about tokenomics of a token. So the first thing we need to talk about is the distribution and allocation of a token. So how are tokens launched? How do you launch? How do cryptos launch? They are launched either by pre-mining or fair launch. So pre-mining, I mentioned ICO earlier. So pre-mining is similar to you distribute the token to some early investors, to some founders, to some early miners, to some early investors. So they have the advantage of accumulating these tokens. But fair launch is, the governance of that token is decentralized from day one. So no body or no set of people or classes of people have more of these assets. And why this is important is that you need to watch out whether there is private allocation of the tokens or not. So it's important because if, let's say, for a project let's take an example, a local project now, the market capitalization of that project is maybe still like 100 million, and 50 million of the total capitalization is with some particular persons. Those persons can do what they want. They can, if they decide to sell off, the price will crash immediately, and if they decide to pump in more money, the price will shoot up. And those kind of projects are susceptible to pump and dump. So you pump in money, the price shoots up, then you sell off immediately, and it's the people or the investors that have the smaller portion that are being ripped off. So so you need to consider that is this coin, was it launched through ICO? Is it launched through fair launch? So of course, I mean, I would definitely advise that you look at projects that are not ICO. Despite, of course, that's not the only thing that you need to consider. You need to consider the use case. You need to consider a whole lot of other things, even under the tokenomics. But you are better off, being part of a project where the distribution is even. It's not skewed to some particular set of individuals, because those people can. It's like you are handing your financial destiny over to those people. So you need to So these are one of the things that you need to watch out for. One of the indices that you need to watch out for when you are looking at the numbers that matters in investing in a token. Now, the next thing we need to look at is, supply of token. So there are three types of supply. There is, circulating supply, there is total supply, and there is max supply. If you go to, say, coingecko.com, where fortunately I can't share that screen now. I don't know why. Probably in our next class I would have gotten a better angle on Facebook Live, but I mean, it's what it is. I just have to make do with this right now. So if you are looking at, there are three types of supplies that you need to look at. There's circulating supply, total supply, max supply. I said this before. And if you go to CoinGecko and you search for a coin, you see those figures there. So circulating supply is the number of tokens that are issued publicly and are in circulation at the moment. Excuse me. Yeah. So then you go to total supply. Total supply is the number of tokens that exist currently minus all tokens that were burned. So I will expatiate on burning of tokens more. And it is, how you calculate it is, if you take the total of circulating supply, which is the first thing that we spoke about, tokens that are in circulation, and you add the total number of locked tokens. So locked now can be, people, project builders build some protocols around their projects that locks up some tokens. So if you add what we have as circulating supply and what we have as locked token, that is how you arrive at your total supply. Then I don't want you to confuse total supply with max supply, because max supply is the maximum number of tokens that can ever be generated. So this is the maximum. So max supply is the maximum number of tokens that can ever be generated. So if you are comparing two projects or two, you are considering investing in two tokens, and you see one that has a max supply, take Bitcoin for example. Bitcoin's max supply is 21 million. 21 million, that's the highest number of Bitcoin that can ever be. So, and you are now taking two projects. So let's leave Bitcoin out now. You're looking at a project that has 10 million max supply, and you're looking at another project that has 100 billion max supply. Of course, basic law of demand and supply is that whenever the supply is high, the price will fall, of course, and whenever the supply is low, the price will rise. Same thing applies to on the other end, to demand. If there is scarcity, that this is the highest number of tokens that can ever exist. Of course, there will be price appreciation. Yeah, all things being equal. That's not the only thing that determines it, but it's one of the factors that you need to consider. Then you look at tokens with total supply. And an example that I want to make is, if you look at Ethereum, you will see that there is circulating supply, but the total supply and max supply is infinity. Then you wonder, Ethereum is a popular project, is the second most capitalized project, and the max supply is infinity. The total supply is infinity. So what the protocol does, or what has been the mechanism that has been built into Ethereum is kind of unique. It's kind of special in the sense that wherever there is any transaction being performed on Ethereum, some Ethereum tokens are being burned. You get right? Let me repeat that. Whenever there is any transaction happening on Ethereum network, some Ethereum tokens are being burned. So you can't really determine the total supply because it fluctuates as transactions are happening. And believe me, a lot of transactions happen on the Ethereum network. Ethereum network it's a highly used network, so a lot of transactions happen on it, and there is there are a lot of protocols built into it that burns those tokens, and keeps the supply on a wrap. So, and one of those protocols is, you guys can check it out. EIP 1559. So it's one of those solutions that are being built, one to to find a way around reduction of the gas fee on the Ethereum network, and also to keep the supply of Ethereum on the wraps, like keep it I don't want to say low, because Ethereum supply is not capped, but just to keep it, make sure that while transactions are happening and more Ethereums are produced, there are also Ethereum tokens being burnt. So it's going to keep a balance. Yeah, that's the word. Just keep a balance between what is being produced and what is being burnt, so that it's not kind of inflationary. Yeah. So the third index that you need to look at is the market capitalization of a token. So market capitalization is a way to determine the popularity of a token. So if you go to major sites like CoinGecko, CoinMarketCap, where tokens are listed, you will see that most times, unless you change, the default setting of the classification is based on market capitalization. So of course, you see Ethereum, you see Bitcoin, you see Ethereum, you see USDT, you see, which one is number 4? I can't remember right now. Those positions change, but it is based on market capitalization. And to calculate market capitalization is you take the current market price of the token and you multiply it by the circulating supply. So that is basically your market capitalization. And in making your decision about investing in a token, you need to know that tokens that are small cap, so small cap is the capitalization is small, let's say around $100 million to let's say $200 million. Yeah, that is still low capped. And then there's medium cap, maybe from $1 billion down, those are medium caps. Then you go to the high caps, which are the Bitcoins, the Ethereums. So those are high capitalization tokens. So for small caps now, I mentioned earlier about if you have a token that is being distributed, the capitalization is small, say 100 million, and 50 million of those tokens are with a specific individual or with some companies, let's say early investors or a venture capitalist company. What those guys are just looking for is how to, maybe 2x their investment. They are not going to hold those coins. So, and when that phenomena is what I call the pump and dump. So when their investment probably gets to, maybe they get 30% or 20 or 50%, they dump, they sell off. So the risk in small cap tokens is that you are at the whims of those investors, especially if you haven't taken a look at the way it's been distributed, and you buy into a coin where most of the coin is with venture capitals and institutional investors. There is that chance that they are going to dump the coin. They are not looking to hold. Yeah. But for large caps now, a lot of money is flowing into Bitcoin, for example. The advantage of large caps is it's less risky, meaning that there is nothing is guaranteed, but there is a higher chance of you getting a return on investment on Bitcoin than say a token that is let's say 560 something on ranking, that is ranked 560 something based on market cap. So you need to watch out for the market capitalization when making a decision on which coin you need to invest in. Okay, so I move on now. So the fourth index that we should look at is also the model. So So there are two models. A token can either be, inflationary, excuse me, or deflationary. So most of the tokens that their maximum supply is infinity, they are inflationary, meaning that you can continue minting them till infinity. So take, for example, let's take US dollar or naira. There is no maximum supply of naira in the circulation or US dollar in the circulation. If the number is not enough, the central bank just prints more. So that is how you can view an inflationary token. So, but it has its advantage, because what this does is that it incentivizes miners, people that are responsible for validating transactions on the network, and delegators. And there are some DeFi protocols that are built on rebase tokens, and the only reason, or a structure that has been built to ensure that early investors stay in those protocols is high crazy APYs. Take, for example, the Olympus and the Wonderland that we have spoken about in our earlier classes. Those rates are ridiculous, but that is a way to keep the early investors that were staking in the project. That's the way to keep them in the project. So it has its own advantage. But the disadvantage, of course, is that you don't want to be in a situation whereby you have 10 quintillion tokens and there is no liquidity in the market. So say the price, say you have okay, let me use a figure that is relatable. Say you have 20 million tokens of something in your wallet, but when you go to an exchange, you go to a major exchange, you go on Binance, you can't see it. You actually can't sell it, because if there's no liquidity to the exchange that you are selling it to, then it's as useless as toilet paper, really. So you don't want to be in that situation. That's one of the disadvantages of inflationary tokens. Then deflationary tokens are capped at mass supply. Bitcoin is going to be 21 million, and a lot of other tokens too. Take Metaverse Index or DeFi Pulse Index, for example. As at today, the maximum supply for Metaverse Index is 241,000 tokens. That is so small. That is nothing, really. So 241,000 tokens. That is nothing. So those are examples of what you call deflationary tokens. That is how they've been built. That is their model. So the next thing I will need to look at, the last thing really on my slide, is to look at the price stability of the token. So tokenomics also point out how important it is to study price stability. Cryptocurrencies are known for their volatility, which might not work in favor of the investor. So fluctuations, when the price fluctuates, of course it will lead to unstable interest and sometimes restriction on the network. So take what example can I give? Take Tron, for example. So there was a time that the price of Tron excuse me. There's a time that the price of Tron was fluctuating up and down. People pump, dump, pump again, dump. Yeah, there was a bit of so that kind of affected, placed some restrictions on the Tron network. So it's one of the things that price fluctuations can cause. Then, as an investor, you need to make sure that the project that you are investing in is doing everything possible to prevent and combat those fluctuations. So, and the way that can be done is when there is adequate tokens to match supply level. So, like I said, you want to make sure there's liquidity in the market, and the prices and of the tokens can be stabilized, and they can be used for what they were intended for by the investors. So one last thing I have here, which I must have mentioned, is not on my slide, but I think I must have mentioned it earlier, is exchange. Exchange. You don't want to, or you would, when you are trying to invest in a token, you want to know that there is liquidity for that token, or you want to know that you can exchange. There are those that token is listed in multiple exchanges, multiple popular exchanges. So preferably, I mean, you're in Nigeria, you want to see that token on Binance. You probably want to see it on Uniswap, or maybe on SushiSwap, somewhere that the network fee will not discourage you from from swapping or from doing the transaction. So that is something very important when you are trying to when you are considering a token to invest in. You need to be sure that there is liquidity and it can be exchanged on major centralized and decentralized exchanges. So coming to the end of this class, it's supposed to be very short. So one of the things that you need to note, I mean, we've been, for the past 4 weeks, we've been talking. If you're in the WhatsApp group, if you're in the community, I know I did some closed group trainings earlier, before now, I mean, for the past 4 weeks, and we've been talking about a lot of things, sharing knowledge continuously. And I mean, things that we always notice that you are, whenever you are trying to invest in a coin, you are responsible for your action. Like I said, I'm not giving you a financial advice. I am not your financial advisor. I mean, it's a disclaimer that everybody that is educating you in the financial market, in crypto, is going to tell you, I'm not a financial advisor. So you have the responsibility to do your due diligence. What I'm trying to do is to educate you on what you should look at, but it's your responsibility, because the action lies on you. Don't say, Ben from Facebook said I should buy this coin, and because I've been following Ben for a while and I like him, I'm going to buy this coin. No, you are about to light your money on fire. Do your due diligence. And how do you do your due diligence when you don't have the knowledge of what to look out for? And that is where I advocate to people in our people in our community, that you need to stay connected to information. So if I hold right now, I'm holding these classes once a week, once a week. If I giving you an information probably today, it's likely that I've known about that information maybe in the past 3 months. But because a lot of things happen in this space fast, and you are still waiting for somebody to come to Facebook Live, or to come to our group meetings to tell you what is happening, you will be feeding yourself on scrap, on stale food. So you need to stay connected to the right source, because like I said, like I've always told my guys, information is potential gold. Potential being that you also need to act on it before it can be refined to actual gold. So stay connected. For beginners, for people that don't know, that don't really know anything about about crypto, about DeFi, I would advise that they go through the Binance Academy. And for people that are probably not beginners, even beginners that want to accelerate their learnings and also combine it with earnings, then I would always, I would tell you that you should stay connected to the DCX Academy of the IMAX Academy. That is where everything is happening. You know, guys, that is where everything is happening. And last week, I mean, there were some people on our group that, you know, we were able to have a conversation with, you know, one of the top educators in that space, and I mean, it was mind blowing. The kind of possibilities, the kind of things that happen in that space, the kind of lives that are being changed, the kind of money that is on the table that is going to be grabbed. It's just crazy, just crazy. You need to get into that community and see what is going on. And you know, beyond, you know, crypto, beyond DeFi, beyond a lot of other things that we do, there are, in fact, if you are talking about only the crypto, for example, you know, all these things that we discussed, I've always been talking about the DeFi. There are a whole lot of other things in the crypto space. You know, you want to learn how to, you know, margin trade, leverage trading, build an investment portfolio. You know, having a diversified portfolio, you need to, you know, invest in probably a mix of high risk, mid risk, low risk. You know, a whole lot of other things, farming, staking, and NFTs. And I mentioned earlier that you shouldn't dabble into NFTs if you don't know what you are doing. And this is where you will learn, you will know what you are doing. You know, if you stay connected to the DXS Academy. Now, beyond that, beyond crypto, like I said, you know, I want you to also come and learn about more opportunities of that IM Mastery Academy. You know, beyond crypto, there is HFX, there is Financial Markets Mastery Academy, there is e-commerce, and there are other things coming up. So, and this is the best time. I like you to give yourself a gift for 2022. Yeah, I mean, for a lot of people in the academy connected, they already see how 2022 is going to be. 2022 is a year of double, you know. And for me, I mean, definitely, it's a year of double for me. So you need to give yourself that gift, you know. Yeah. So I will probably be you know, dropping the video for this training in our community. So if you are not yet a member of that community, I think you need to join as soon as possible so that we can stay personally connected. So then also I'll be talking about, you know, the topic for the next class in the community. I've not yet decided, but you know, we'll see how it goes. And that's why, you know, guys, you need to stay connected to the source. So I'm not feeding you scraps. You understand? Okay, so thank you very much if you are still on the call. And for the people that will be watching this replays earlier, if you have any questions, you can, you know, send a friend request. If you are not yet my friend, follow my page on Facebook. I drop, you know, correct information for you guys, so that excuse me. Yeah, and if you want, you know, videos of the previous trainings that we've done, just reach out to me and I will give you that. So guys, thank you very much, and see you on the